are expensive or impossible to unwind. Once you build that infamous bridge to nowhere, you're not going to melt down its steel girders to use somewhere else, and you'll never recover the skilled labor that built it. Some other company could have used that steel and labor more productively, and that's a loss for the economy. Personally, I don't think that short sellers are a problem. I don't approve of short and distort, but it's just the flip side of what happens with long positions. That's pump and dump. In pump and dump, the bad guys take a long position, betting that share prices will rise, and then they start favorable rumors to try to get the target stock's price to increase. If you think that short and distort is wrong, then you have to agree that pump and dump is just as bad, and that has nothing to do with short sales. The problem is intentionally spreading false information, not short sales. I'm certainly not going to defend people who do this. I just don't want you to think that short selling is to blame. As for the second alleged problem, the people claiming that short sellers are wrong and driving down the share price are often high-level managers of a company that's experienced a big stock price decline. At the same time these managers are saying that the stock market doesn't recognize what a great company they have, some analysts are saying that those managers have done a bad job. If they really have done a bad job, then the short sellers are just betting that the bad managers will eventually ruin the company and the stock price will fall as a result. I can't blame them for acting on that belief. You can probably tell that I don't think that banning short sales is a good idea. I'll give you 4 reasons why. First, short sellers add liquidity to markets. Given that a quarter or a third of all sales are shorts, a ban would cut trading volume a lot. For most stocks, there would still be plenty of liquidity in most cases, but for more thinly traded shares, buyers might have more trouble finding a seller. Second, the evidence suggests that short sales tend to drive prices to the right values sooner rather than later. There's evidence that prices get too high without short sales. We've seen that that would cause problems for the economy. Third, short sellers have been among the first to identify financial fraud. James Chanos, a well-known short seller, identified what seemed to him to be fraudulent accounting practices that occurred with an energy trading and utility company. That was in 2001, and the company was the Enron Corporation. Time proved him to be correct. Cases like this suggest that, far from being a problem, short sellers can do a lot of good. Finally, bans just don't seem to help. Professors Robert Battaglio and Paul Schultz of the University of Notre Dame, along with Hamid Miran, an assistant vice president at the Federal Reserve Bank of New York's Research and Statistics Group, studied short selling with a focus around the financial crash of 2008. U.S. regulators banned short sales of financial stocks in 2008. They were worried that shorting was contributing to the big declines in those stocks at the time. The trio of researchers found the prices fell noticeably during the 2 weeks while the ban was in force and then steadied after it was removed. The short sale bans increased trading costs too. The authors estimated that the ban cost traders in U.S. markets about $500 million from September 18th through October 8th, 2008 by reducing liquidity. To check their conclusions, Battaglio, Miran, and Schultz studied what happened after the downgrade of the United States credit rating in 2011. They found that stocks that you couldn't short actually did worse than stocks that you could short. Opposing a ban on shorting is a far cry from suggesting that people like us should conduct short sales. We're investors, not traders. We're looking to make money over a reasonably long period of time, certainly longer than people hold short positions. Short sales are very risky indeed, and we can get a better expected return without taking that risk. We don't want to fight battles when the odds are against us. I don't recommend that you short stocks unless you've been investing for a while or if you're just doing it for fun and don't care if you lose some money. After all, Nobody cares if you spend some hard-earned cash on football tickets when at the end of the game all you have are some pleasant memories of a good time. If you think it'd be fun to short some shares, then fine, short away. Otherwise, until you get a lot of experience, don't try to make money by shorting stocks. In our next lesson, we'll examine some common trading strategies, identify some common trading mistakes, and explore the fascinating world of options.